They're both places I can type information, but I use one sometimes for certain things and others sometimes for different things. So the way I think about it is at the most basic level, we have banks for the same reason that we have the post office. It's for a historically vestigial reason, okay? Once upon a time, in a pre-technology era, the only way to move money or information from point A to point B was to take all of the money or all of the information and aggregate it in one place. And then you could lend it out to some people and you could collect payments from other people all in that central hub. That's why, if you think back to the medieval origin of banking, it was really to finance the great wars of Europe, where you might have a king of England trying to finance a war with the Duke of Padua or whatever, and they didn't know each other, and the people who wanted to finance that didn't know each other, and you needed some central trusted ledger keeper. That was necessary at a time when we didn't have technology, but now we have technology, which may mean that we don't necessarily need either the service of a central ledger keeper or the aggregation of all the money in one place to be borrowed and lent, because the technology makes it immediately possible for you and me to transact directly, even if we don't know each other. We used to need banks for that, but now we have technology for that. And so at the most basic level, that's what's going on. When you talk about stable coins versus when you talk about Bitcoin versus when you talk about privacy tokens, these are all doing different things, much like the communications apps on our phone. So if you ask me what's the thesis for Bitcoin, the thesis for Bitcoin is one day it's possible that America and Europe and other places will adopt monetary policies that look like Venezuela's monetary policy, and government-issued currency will no longer have value because it will be debased, right? As Brad said on your previous conversation, at some point there will be real inflation in the system. So that's the thesis of Bitcoin. It's not supposed to do anything other than be rationed. That's its core value. Stablecoins are kind of different. The idea of stablecoins are, hey, we could take something that has a knowable value. We could either back it based on an algorithmic activity, or we could back it based on dollars in the bank. But we could take this thing that we know has value and we could internetify it, right? We could make it so that it's programmable and instantaneous and doesn't rely on the internal workings of a bank to transact. So it's like we know people want this because they already sign up for Zelle and Venmo. But the problem is Zelle and Venmo aren't interoperable with each other. They're closed loop kinds of systems. Stablecoins are all about the concept of the internet, fully interoperable. You don't have to be on Zelle to receive a Venmo payment, right? Here, I can transact with anybody who's connected to the internet, and that's a good thing for stablecoins. And then ultimately, really, Chris, I think the real use case of crypto is in a world of increasing integration and increasing globalization. It really makes no sense to think that anyone across borders who wants to transact with each other has to pay a foreign exchange fee to change yen into dollars, let's just say, and then also to pay a money transmitter for the act of hitting the send button and sending that money across a proprietary platform. Imagine if there was a single token that was recognized on both sides of that divide. And when you received it, you could cash it out into your local currency. And when I received it, I could cash it out into my local currency without the need to change it, right? Those kinds of things occupy so many trillions of dollars of friction in the system that it's, when people say there's no killer app to crypto, I sort of think, no. The killer app of crypto is the simplest application, which is avoiding frictions. That's what it's all about, much as the internet did for sending information.
You talked about sort of, or you conceive and think about the use case for crypto really from the standpoint of decentralization combined with, I guess, a kind of interoperability, especially in the case of stable coins. But writ large, I guess crypto then is obviously one of those tools fueling the decentralization of finance or DeFi. And you've observed on many occasions that the other sort of force reshaping banking is something that you describe as unbundling, right? And that really goes to what you were just mentioned in terms of the historical sort of evolution of the origins of banking, and now you're trying to sort of identify or think through what banking looks like now. But I think let's try to go that direction a little bit more explicitly. What does banking look like for you after unbundling? Sort of post DeFi? What do you see from an operational standpoint in terms of the place of banks, right, in the banking system, and literally what it means to be a bank, And then what do you think consumers would then be able to look forward to, and the challenges that arise?
Yeah. So Chris, here's how I think about it is, and I think you're exactly right when you say, what does it mean to be a bank? Because I think the nomenclature sometimes gets in the way of having this conversation. So let's start with first principles here. Human beings need financial services. They don't need banks. Banks are entities that exist among other entities to provide financial services to people. So when I say that, what do I mean people need financial services? Well, it's like most of us could not afford to buy a house if we had to pay cash for it. You have to be super rich to be able to just write a check for your house. And so we need someone else to float us that money for a period of time, and we're willing to pay them a rate of interest on it. So we need lending like that. Businesses sometimes need leverage in order to achieve target rates of return. So again, they need to borrow money from someplace in order to do that. People need to go to college. That costs money. Many of us take out student loans to go to college. Or, we need to pay the babysitter and we want to write her a check or send her money from an account. So we need some place to process that payment, but we also need some place to hold our money in some safe way, which we call deposits typically. Those are things we need to live our lives. The companies that have historically served those needs are called banks. But the reason that those were the kinds of companies who served those needs was because, again, in a pre-technology era, we needed one place to hold all of the money in order for it to be efficient to provide all of those other services. And so banks could gather deposits on a low-cost basis and then use that giant amount of money to make loans and do all kinds of other things. In steps technology. Suddenly, Chris, it is possible for you to just go online and say, hey, listen, I've got $10,000 here, and I'd like it to earn 5%. Does anybody want to take my $10,000 and pay me 5%? And the algorithm will find someone who does. And all of a sudden, there's no longer a value in the bank aggregating all of that money together because the technology is substituting for the aggregation function of banks. Whoa, right? And if that sounds complicated, just come back to the post office analogy that I usually use. Back in the day before there was email, the only efficient way for me to send information to Chris across the country was I would take a letter and I'd go take it to the mailbox, and the mail collector would come and put it in one giant repository of all of the thousands of letters everywhere in the United States. And then they would say, okay, all letters going to New York, get on this Pony Express. All letters going to Los Angeles, get on that Pony Express. And they do that like once a day. That made sense before we had technology. But with email, we don't need the aggregation anymore. We don't. We can do it directly with each other and forget the aggregation. That's what it's ultimately all about. So the question, what are banks going to be good for in this era, is a really interesting one. I think the truth is they're going to be good for a lot, just not the aggregation of money necessarily, right? So what I think banks are great for is they're great for value add services. They're great for advice, for fiduciary stuff, for custody of physical assets. And eventually I expect that banks, much as the banks are all connected to the Fed payment system, they're all connected to the automated clearinghouse system and the SWIFT network, I expect that there is a future where banks will be directly connected to blockchains where, they will see that as a payment network and they will become nodes on that network along with all kinds of other companies that are also nodes on that network. If that happens, banks may be able to mint their own stable coins, in a way that would allow them to very readily design value add money transmission instruments, much as, American Express innovated the world of traveler's checks 2 generations ago. So I think there's a huge role for banks, but it's a transformational role because the legacy role of being an aggregator of dollars may be completely disintermediated, which will then allow them to focus on the higher value add, higher profit services that they are best at anyway.
Do you have a sense, you have an insider's view on so many things that are happening both in the banking space and in the blockchain space? I mean, do you have a sense as to, or do you anticipate that transformation being faster, slower? Certainly it would depend on a number of factors. What do you perceive as the major factors driving that transformational change and the degree to which the federal regulators are going to have to sort of grapple with it? What are you seeing in your brief but very active time over at the OCC?
Yeah, well, I'll tell you, Chris, on the brief but active thing, I am a big believer in the idea that it's not about the age, it's the mileage. So we got a lot of mileage on it. But look, the mistake I think that regulators often make is the belief that if something new enters the system, the new thing is risky, relative to the old thing, which because it's old is somehow seen as not risky. We need to recognize that the status quo is risky in all kinds of ways. There's a lot of money laundering that goes on in the status quo banking system. There's also a lot of interest rate friction, a lot of chargeback risk, and all kinds of other things. So the first thing we need to get comfortable with is the idea that the status quo is not the risk-free environment. It has a set of risks and benefits, and change has a set of risks and benefits. So we should always be doing a net risk calculation, not like a sort of a standalone risk calculation, is the first thing I would say. And then, where I sort of go is the notion that in the future, for banks to perform the services that people need, they're going to have to sort of compete with other alternatives. That's as true for regulators as it is for innovators. So if you look at the US relative to other countries right now, the EU has published a draft stablecoin framework. We haven't. We've made a lot of law enforcement statements about how we expect BSA and other things to be complied with, but we've said nothing about how, like, these are the conditions under which we think a stablecoin would be a good thing for the country. Instead, we're still talking about a government-built token system that might come online in 4 years. So we're years behind places like Europe in terms of articulating what we think could be a framework to let these things grow. In the meantime, corporate America is not waiting for that. So we've all read a lot about Facebook's Libra project with its various ups and downs. We've read less about other stablecoin projects like the Circle partnership for USDC or the Gemini coin or the Paxos coin. But if you look, Chris, over the last month or two, and you just look at the growth trajectory of these stablecoin projects, these have been doubling in market capitalization roughly every 60 days for the last 6 months. That's an incredible hockey stick asymptotic rate of growth, which tells us the market wants these things and the market will have these things. So we can try to push back as long as we can, kind of like the taxi cab commissions did with Uber, and we saw how that ended. Or we can embrace it and say, look, the good parts of this are very, very good. And we need to come out now and get in front of it by saying, we're okay with these projects as long as they meet these parameters, and only outside the parameters are we going to have problems. We need to be clearer about that if we want to be competitive as a country and if we want to avoid bad outcomes as markets move in the direction they're going to choose.
So let's, we don't have too much more time, so I want to just switch gears to a couple of things that I know people here in Washington, D.C. are thinking about. Many of the objectives of the work over the OCC has to do with increasing financial inclusion. And, when we chatted just last time, I think in June, we had discussed the Community Reinvestment Act. And since then, the Fed has issued, an advance notice of proposed rulemaking, sort of starting or kickstarting its own formal rulemaking. And there's some overlap between what the Fed is thinking about doing and obviously what you've proposed, but there are also some important differences. I mean, what would you highlight about the OCC's rule when people are trying to compare the two rules, and what do you see as the primary points of collaboration or overlap, and then where do you see the two approaches diverging the most?
Well, look, Chris, first of all, I appreciate you asking the question. I think the Senate is going to be voting on the Community Reinvestment Act rule today, actually. So it's a really good day to have this conversation. First of all, I'm a big believer in Ronald Reagan's dictum that it's amazing what you can get done if you don't care who gets the credit. So credit where credit's due. I think there's a lot of good stuff in the Fed's rule. And it is very possible that their ANPR will result in new ideas and intelligence that we have not considered that we could look at, next year to make our rule even better. So I think that's terrific, and I welcome what they're doing. At the same time, I'm also a big believer in not letting the perfect be the enemy of the good. And I think everybody gets, and I think the Fed's release shows that they agree, that the status quo is untenable. It's just untenable. And it's untenable because it ignores the fact that banks mostly do not provide their services through branches at the level that they used to 25 years ago when the CRA was last revised. And so we need to get away from branches as the touchstone of geographic assessment areas, and the Fed's rule does that. I think there's also a recognition in the Fed's rule, as in the OCC's rule, that there are groups that were excluded from CRA benefits generally that shouldn't be. For example, Indian country or farming communities, which really were never captured in the original concept of the CRA in 1977, when it was really focused on urban blight and redlining in big cities. So they do all of those things. I would tell you the main area of difference, I mean, there's a few others, but the main area of difference between our rule and the Fed's rule seems to be in the nature of discretion and how much subjectivity should there be in rating how banks perform. That's an issue where I'm happy to sort of put it out there for kind of a general plebiscite. I mean, who thinks it's better for bank examiners to subjectively decide whether a bank has done enough versus telling banks clearly what the rules are and what expectations we think they should meet? It would be sort of like, who wants an objective speed limit on the freeway where you know you're not speeding if you're not driving 75 versus a subjective rule where you can be pulled over anytime a policeman thinks you're driving maybe a little faster than he'd like? I think that question answers itself. But other than the discretion and the subjectivity, the rules are largely similar, which I think is great. And again, if we learn things from their ANPR, we're happy to make it better. We're not here for the credit, right? We're here to make credit and investment more available to the people who need it most.
Right. Well, we only have a minute, but I did want to speak as well to a question that many people are asking, particularly as the economy is sort of decelerating a bit. Not just the United States, but the world is still struggling to manage COVID-19. What's your sense as to how the banking system is holding up? I mean, how well are policymakers doing in balancing different kinds of risk and reward trade-offs? And then secondly, when you look at the health of the banking system, how does that impact your decision-making when it comes to these new financial products and the evolution in banking with obviously the rise of stable coins and other kinds of digital assets?
Yeah, well, that's a lot. So I'm just going to tick off a few things because I know we've only got 60 seconds left. So first of all, I'm going to say the economy is not decelerating. The rate of acceleration is slowing, but we are still expanding. So let's be super clear. There's no deceleration out there. Second, in terms of the system seems to still be okay. I mean, we're coming to the end of the additional runway provided by PPP and other programs. But on the other hand, unemployment continues to fall and consumer spending, retail spending, and other things continue to rise. So I would say that we may thread the needle on this one. I certainly hope that we thread the needle, but that does depend on the economy reopening as fast as the PPP proceeds and other things are running off. Those lines need to intersect at the right moment for us to be okay. Banks are well provisioned, obviously, all of that stuff is good. Then you get to the question on, are we balancing costs and benefits right? Listen, does anybody think we're balancing costs and benefits? Does anybody think that there is any factor driving decision-making in this country right now other than COVID? I think not. And I think as a society, we do need to start having the conversation of, if somebody told us that our mortality risk in the society went from 0.0001% to 0.002%, which would be a doubling, but from one small number to another small number, and the cost of that, of shutting down in order to avoid that other small number, is mass dislocation and suicides and depressions and divorces and everything else, I think you would say we're only focused on one objective right now. And we're a big enough country and a good enough country. We can talk and chew gum at the same time. We can balance risks and benefits. We can understand this virus isn't going to go away if we lock down. That's not what viruses do. So what we need to start doing is understanding, how does an economy live with this thing and thrive and grow? Other countries are doing that. The news this morning is that China's productivity post-coronavirus is almost where it was pre-coronavirus, and that's in less than a year. Ours is nowhere close to that, although the trend lines are good, and it's nowhere close because we refuse to accept that there are other values in society in addition to coronavirus avoidance. So I think we need to balance risks and benefits of all of these things to come up with the right place. I think the trend lines are positive, but I would not say we're out of the woods yet.
Thank you so much, Ryan. As always, the OCC has been with DC FinTech Week from the very, very start years ago. And as always, we're really appreciative of the OCC and you and your support. We're going to be following this discussion and moving forward with a conversation on just how stable are stablecoins. And it'll be coming up right next. Well, I'm really looking forward to this panel, and I would like to welcome Aaron Stanley of Coindesk And big thanks to Coindesk and the Coindesk team for being one of our knowledge partners today. And Sanaya, thank you very much as well to Teja from TD Ameritrade, who was back from earlier today and on our panel on what's happening in crypto in Asia. And they will be here to moderate today's stablecoins panel. So please take it away.
Aaron, your camera is muted.
Great, thanks, Chris, and welcome everybody to our panel on stablecoins. My name is Aaron Stanley, and I'm managing director here for events content at Coindesk, which is the largest blockchain digital currency focused media and events company out there. I'm joined by Sunaina Tuteja, head of digital assets at TD Ameritrade. And for the next 45 minutes, we'll be digging into the topic of stablecoins. As Brian Brooks was just mentioning in the previous session, the third quarter was probably the biggest ever for stablecoins, not only in terms of market cap, but also in terms of adoption and the regulatory roadmap. So we're going to be diving in and breaking that all down for you. Sunaina, do you want to introduce yourself quick and then introduce our panel for today?
Absolutely. Thank you, Aaron. And thank you, Chris and team, for always finding the art of the possible and bringing us all together. Even though we can't all be in our favorite city of DC, it's great to be connected to amazing panelists offering amazing perspectives from around the world. And for me personally, it's a nice pivot from all the binge watching I've been doing to a week of binge learning. So thank you. As Aaron mentioned, I'm the head of digital assets at TD Ameritrade. Clearly stable coins are top of mind, as you even heard, Brian in his conversation with Chris just now. And, I know every moderator is going to say this, but Aaron and I frankly believe that we have an all-star panel assembled here who represent operators, investors, regulators, and will really offer us a diverse slate of perspectives on this topic of stablecoins. And one of the cool things I also like about this panel is they come at it in a very balanced view. And what I mean by that is often things in crypto are nicely packaged with a healthy dose of hype and hyperbole, and stable coins are no exception. And, they're often presented as a panacea. And what's great about this panelist is they have a deep reservoir of expertise in this area, but they present to us not just what the opportunities are, but also what are the challenges and how we ought to pursue this exciting area of crypto with eyes wide open. And with that, I actually want to welcome our panelists and give them an opportunity to briefly introduce themselves. And I'll start with our friend Nick Carter, sporting his fancy Bitcoin pin there. So Nick, passing the baton to you.
Thank you, Sunaina. Thanks for having me. Chris, thanks for the invitation. It's a pleasure to be here, third year in a row. It's my favorite conference. I'm Nick Carter. I'm a general partner at Castle Island Ventures, which is a early stage blockchain focused venture fund based here in Boston. So we invest in financial infrastructure, startups building on top of public blockchains. And obviously stablecoins are a key linchpin of that. They're kind of a core shared permissionless infrastructure that a huge number of startups are building on these days. And so that's why we're so focused on the opportunity. I'm also the founder of Coinmetrics, which is a blockchain analytics startup. And we cover a huge amount of data pertaining to stablecoins. One of the amazing things about them is that you can directly see in real time the usage traits and the free float and the growth in market capitalization, which has been pretty astonishing this year.
Thank you. Fanny, over to you.
Hi, I'm Fanny Wang. I'm a lawyer turned entrepreneur in the blockchain space. I've worked in a variety of different projects since 2016. Most recently, I was Associate General Counsel at MakerDAO, which is a decentralized stablecoin platform. And I'm currently working on a few of my own projects and also working with the Red Cross on their own community currency program, which is a kind of stablecoin that is designed for economic activity for people who are living on $2 a day to actually generate more real production in the flow of goods and services amongst these communities. So happy to also talk more about that.
Looking forward to it. Always inspiring. Nigel, over to you, please.
Thank you very much, Sunaina. Thank you very much to you and Aaron and to Chris for the invitation. I'm Nigel Jenkinson. I'm the Division Chief of Financial Regulation Supervision at the IMF. And the role of the team that I work with is to provide advice and support on anything in the area of financial regulation supervision. Clearly, fintech is hugely important these days, and stable coins are one important aspect of that. And recently, I'm a member of the FSB Working Group on Regulatory Issues of Stablecoins, which issued its report last week. So great to join the panel today. Thank you.
Thank you. We'll definitely be digging into the regulatory aspect quite a bit, so appreciate it. And last but not the least, our friend Alexander.
Well, everybody, Chris, thank you very much for the invitation. Sunana, Aaron, thank you for agreeing to, to run this panel. My name is Alex Lipton. For a little while, I was a professor of mathematics, and then for about 20 years, I was in investment banking, including the position of the global head of quants for Bank of America worldwide, and also quantitative solution executive for the holding group Bank of America. And then in 2016, I decided to go a little bit back to my academic roots, as well as to start an entrepreneurial enterprise. And so I became a fellow at MIT, a professor and dean's fellow at the Hebrew University, and the co-founder and chief information officer of SELA, which is an innovative programmable money provider based in Seattle, Portland. Portland, Oregon. Portland, Oregon.
Awesome. Never a dull moment in Alex's world. Okay. So, as you've been hearing today, a lot of talk about stable coins, and we certainly see a massive adoption and also proliferation of stable coins. But, an outcome of that has also become where stable coins have kind of become a catch-all for a lot of things that might or might not be a stable coin. And within the stable coin ecosystem, there's also, a multitude of use cases. So maybe let's start with some fundamental taxonomy. And for that, I would love to have Nick and Nigel weigh in, and maybe Nick, starting with you, looking at it from the perspective of the crypto world. How would you define stable coins, or as you coined the term, crypto dollars? And then Nigel would love to have your perspective from an IMF standpoint, how you define a stable coin and the difference between, a quote unquote stable coin and so-called global stable coin. So I think different perspectives, but important for us to hear it out. And Nick, I'll pass you the baton first.
Sure, thank you. And I definitely didn't coin crypto dollar. I'm just an enthusiast of the term and a supporter of the term. I think it's not set in stone, the fact that stablecoin will be the dominant term that's used here. I know whenever I see things from regulators or like the FATF, they don't really like the term very much. They claim that it's promotional, and so they call them so-called stablecoins. So maybe a new term will emerge over time. It's not clear. The way I would define it would be a token circulating on a public blockchain, which is designed to track the return of a sovereign currency effectively. And there's a number of ways that this is attempted. One way is to have convertibility for dollars held in a, effectively commercial bank liabilities for deposits held in a bank. And then the other way, which is also pretty common in the crypto industry, is to create a reserve of risky collateral, which is kind of managed. And so that's not a convertible approach. So those are kind of the two main. So you have kind of the synthetic stable coins and the convertible stable coins. There's also algorithmic ones out there, which are sort of more exotic. Now, again, I think crypto dollar is more suited to describe the phenomenon, because we're talking about, for the most part, they're dollars. If you look at them, about 97% of all of the sort of circulating stable coins try and track the return of the dollar. And then crypto, to me, connotes the fact that they circulate on these open networks. which seems really important to me because that's kind of the core value proposition. If you ask people to use stable coins, why they use them, it's because of this lack of encumbrance. So I would question if it would still be, a true crypto dollar if it was circulating on a private blockchain, for instance.
Thank you. Well articulated always. Nigel, love to hear the perspective from an IMF vantage point.
Okay, thank you. Well, thank you, Sunaina. And just following up from Chris, I mean, I think the word stable coin is one that is bandied about a lot, and indeed, the report that I was a member of the group on used the term so-called stable coins, because I think there is unease about the term as Nick described. But my definition would be, or categorization would be, it's a specific category of crypto assets, which aims to maintain value against a particular currency or currencies, or potentially something else, such as a commodity or basket of commodities. That would be how I would term stable coin, but I think as Nick described, there's many different types and varieties of this. So I think there is a question about the term. On your point about global stable coins, I think a global stable coin is one which essentially is viewed as having extensive reach, within and across borders. So it's one that has a potential global and significant cross-border reach. But that would be how I would define it, Sunaina. Thank you.
Great. Well, thanks both for that. Now that we're all on the same page, more or less, as far as how we're defining these instruments, we're going to dive a bit into how they're being used and the volume at which they're being used. And I think the third quarter of 2020, as we mentioned earlier, is really a seminal period of time for stablecoins. In just 3 months, the total market cap of these instruments nearly doubled from 12 billion to 20 billion. And that $20 billion figure marks like a more than 1,000% year-over-year increase. So it's definitely the hockey stick growth, as acting Comptroller Brooks was alluding to on the previous panel. And we've been seeing stable coins being issued across a broader array of different blockchains as well. So there's stable coins beyond like Tether, which is kind of the largest by market cap. But there's multiple other stable coins that are being issued across different blockchains, and there's a massive amount of uptake here. So there's a lot of factors that are driving this. So I think we'll turn to Nick initially, because that data I was just stating was from Coinmetrics, your company. So maybe let's get some color from you on just the uptick in adoption here, and then so who's issuing these? Like, what are people using them for? And then I'd like to turn over to Fenny as well to talk a bit about what you've seen in the maker ecosystem with DAI. So Nick, go ahead.
Sure, yeah. So the biggest stable coin, again, people might question whether it would be considered stable or not, is Tether at about $16 billion of market capitalization, which is much larger than the second largest one, USDC. And one of the interesting features of the system is that the entities that use these stablecoins don't necessarily want third parties to know what they're doing with them. So it's always a challenge to get reliable data on what the usage modes are. They follow kind of a semi-private, not fully private, but sort of semi-private model where you don't necessarily need to, share KYC data with the blockchain to make a transaction. All you need is a wallet, effectively. But there are kind of a few key catalysts which I think can help explain the growth of stablecoins. One is more crypto companies denominating their balance sheet, transforming their working capital into stablecoins to have liquidity, which is present on crypto rails, which means they can kind of access opportunities much more quickly as opposed to having fiat currency in banks on their balance sheet. Another one would just be the rise of commerce denominated in stablecoins. There's plenty of venture funds out there that are settling deals in USDC terms instead of sending bank wires, because these are 24/7 networks. You can settle and close a deal on a weekend. And then one interesting feature of the last few months is the rise of, this is a very idiosyncratic crypto concept, but the rise of kind of yield farming, it's called, which is effectively a new way of issuing pseudo equity tokens on public blockchains. And the way that people would get exposure to that would be by effectively locking up some collateral in a smart contract. And the preferred means of doing that was with stable coins. And so that caused, it basically created, structurally high interest rates in the crypto industry on public blockchains. And that sort of sucked in a lot of collateral from the regular banking system into the crypto system. So that probably explains a lot of the growth in the last year. But as I said, some of it is also a mystery because stablecoin users aren't necessarily that forthcoming with their intentions.
Great, thanks for that. Fenny, what have you seen in the maker ecosystem with DAI?
Yeah, so I'll explain a little bit for those who aren't familiar about Maker and how DAI works. So DAI is a little bit different than a stable coin such as USDC. So going back to perhaps the taxonomy question, you have certain types of stable coins that are one-to-one backed by fiat in some bank account. There's an issuer that's regulated in some form. So we're seeing new regulation trying to clarify that. But in those cases of USDC, there is a dollar somewhere, and against that, you can issue this ERC token representing a claim on that dollar in a bank account somewhere against the issuer. But what's different about DAI stablecoin is that it is possible for someone to generate or issue DAI themselves against their crypto assets. So what's different here is you are putting up your crypto assets, say Ether, as collateral against which you can issue DAI. So you get the benefit of having a stablecoin like DAI, which you can use in various applications as a form of crypto payment or for the yield farming phenomenon that Nick described. But you get to also keep your underlying collateral. So if I wanted to get USDC, I would have to sell, say, ETH or some other, or use cash to get the USDC and do something with it. But with DAI, I could generate it by putting up my crypto assets as collateral. Now, of course, there is a collateralization ratio, so I have to over-collateralize against the amount of DAI that I'm generating. So if the prices of the underlying collateral decline, then there's a risk of getting liquidated. So that's how the overall MakerDAO system works as a general concept. There's been exponential growth in the supply of DAI the last couple of months because of what's been happening in the decentralized finance markets with the advent of yield farming, as Nick described. So I think I'm looking actually at the block Explorer right now. So this is all up-to-date information. There's close to $1 billion or $1 billion actually worth of DAI outstanding in circulation. So it's quite a phenomenal level of growth. And there's questions as to how these different types of stable coins will be used and compete as the market matures, which I think is quite exciting.
Great. So since we're kind of on the topic of decentralized finance right now, and we're talking about yield farming and some of these other applications, maybe it'd be a good time to dive into that a little bit more, just briefly. One of the big sort of developments of the last few months has been the emergence of these new exchanges that are essentially automated market makers, and a lot of stablecoin volume has been locked up on these exchanges, or have been provided as liquidity on these exchanges. Alex, can you explain to us just what exactly like an automated market maker is, and why people are putting their stable coins in these protocols?
Oh, yeah, with pleasure, Aaron, with pleasure. So, automated market maker is actually an idea which is very pertinent to the framework of Ethereum and other blockchains, which provide consensus as a service, if you wish. That's what Ethereum really does. And then you can run all kind of tokens on Ethereum itself without bothering to make sure that they are internally consistent, because that would be done for you by the Ethereum protocol, right? Of course, make no mistake, Ethereum protocol is not nearly as powerful as people think it is, and it's extremely expensive. So basically, it all comes with a price tag attached, and clearly, some other consensus mechanisms are needed in order to make this whole idea practical. But however it might be, given that in the real economy, interest rates are de minimis, people are looking for something else to do. And so one possibility is to become a market maker, right? Right now in the real economy, only huge really huge efforts need to be exerted to become a market maker. So the Citadels of the world, one of my places where I used to work and so on and so forth, are very, very big, but they spend billions and billions to build the infrastructure and so on and so forth, whilst smart contracts offer a very cheap alternative. You put in a pool of liquidity on both sides of a market-making effort. So, for example, between two stable coins or between Ethereum and say USDC, something like that. And then you actually follow a very simple rule. So, for example, one of the popular rules is that the product of the number of tokens on one hand and the other hand is constant, as simple as that. And indeed, if you think about it, this rule will never exhaust the pool. It will adjust to the outside evolution of the price, etc., etc. And then what is bad?
So what's my motivation for, like, what would be my motivation to put my DAI into
well, I will come to that, because by doing this, right, you become a market maker. So being a market maker is simultaneously an obligation and a privilege. On the privilege side is that you will be collecting the bid-ask spread. Essentially, when I try to take, for example, one token in exchange for the other, I actually need to put a little more of the token which I need to put in, and that is kind of bid-ask spread. Essentially, think about it that on top of the equilibrium price, you will be kind of collecting 1% bid-ask spread, which is a perfectly legitimate way to do this, and that's how it is done in real world as well. Maybe not 1% smaller than that, but still, right? And then, if the price of these two tokens oscillates around the equilibrium, then you will be chocolate, because you will be collecting this premium, and it will be a machine for producing essentially yield, right? So you put in two pools of collateral, and you now get a constant reward, right, in the form of dividends or interest. You can think about it as as a bond of some sort. However, as everything else, the hype goes ahead of common sense. So essentially, the product itself has, in the parlance of conventional mathematical finance, has negative convexity. It means that deviation from the equilibrium in both down and up will always result in the owner of the pool actually losing money. This is kind of the way it is done. As I said, if people don't like the word stable coin, they should probably like even less the concept of impermanent loss. So impermanent loss is perceived that when you deviate from the equilibrium, you lose money, but then you will come back to the equilibrium. So if it does come back to the equilibrium, you receive your returns in the form of market making fees. However, if it deviates away from it, you will lose money, and arguably more than you put in. So that's in essence how the whole thing works. To make a long story short, the smart contracts allows you to compete in a very naive way, but still to compete with big boys and girls who are doing market making for a living. And if everything goes well, you will be receiving a stream of dividend for your effort. Yeah, that's
sure. So it's essentially the democratization of market making.
Precisely. You can think about it like
any average Joe can pool his. Like I for instance have some DAI pooled in a Uniswap liquidity pool right now, and I'm earning a steady flow of the trading fees that come across that. And I guess I probably am a little bit naive about it, as you mentioned, but I'm one of those naive people. But
well,
but I'm learning.
Markets.
That's the fun thing is that we're learning. Like we can actually experiment with these things and learn on our own.
Exactly.
It's not just for the Wall Street elite.
That's exactly right. That's exactly right.
So Sunaina, since we're kind of talking about use cases here, did you want to tee up kind of next round about just where where else these coins are being used, aside from automated market making?
Yeah, and you made a good point there that these things are supposedly built for people not just on Wall Street, and maybe I would kind of offer the contrarian view that while the ethos of financial inclusion and leveling the playing field for the masses is a stated goal of many crypto projects, especially in stablecoin, we still have a pretty wide delta between that rhetoric and what we're seeing in terms of actionable use cases. So, maybe Fenny, you can convince me otherwise, because in your opening, you did talk a little bit about, the merit of using stablecoin for community initiatives and how it can help local economies, and really kind of, bearing the fruit of financial inclusion. So would love to hear more about that.
Oh, that's a great question. Thank you for that. So my first observation, having been in the DeFi space, is that all of these stable coins today, they're really primarily used crypto natives for crypto trading, speculative activities around whether it's DAI or USDC, and actually even with the one-to-one backed stable coins like USDC or Gemini Dollar or Paxos, I mean, in theory, there shouldn't be any fluctuation in the price of those stable coins because the issuers are regulated, and so you're supposed to be guaranteed this redemption at par. Actually, that's what the regulation in Europe around stable coins is clarifying, is this guarantee around redemptions and what those rights look like. So then I thought to myself, well, why is it that these stable coins all fluctuate in price? And it's because of the activity profile of who's actually using it. And where I get concerned is that if you have your predominant users of these stable coins are using it in these high volatility contexts for speculative purposes, is it wise to have ordinary consumers use the same asset? Because what you're effectively doing there is have the ordinary businesses and ordinary consumers who just want to use it for payment purposes, in effect subsidizing the stability or volatility of the activities of all the speculative trading using that stable coin. So that's one thing I don't think, it's a very subtle point that I don't think is appreciated yet. So that gets me to the point of, well, how do we think about using these stablecoin mechanisms in a way that is directly designed for stimulating actual economic productive activity? So this is where I get to the phenomenon of local currencies or complementary currencies. The idea around a community currency predates stablecoins way back. And Nick probably knows this history better than I do around free banking. So when banks were plentiful, they would issue their own sort of note. And then communities would also issue amongst themselves their own form of local currency, or basically like a voucher where they said, well, we don't have money, we don't have federal dollars, but we've got goods and services, we've got economic potential here. So instead of trying to barter, why don't we create this voucher that we will accept as if it were currency amongst each other so that we can stimulate economic activity? And as these projects kind of moved on, what they've discovered is that these local currencies are a great way to ensure that that capital and funding stays within a local economy. So the velocity of money is actually much higher for local currencies than the national currency, because you're forced to spend it within that locality. And what's very interesting is taking this concept and turning them into cryptocurrencies for efficiency and greater data visibility. So a project that I'm working with the Red Cross in Kenya, they've been doing local currency programs predating crypto since 2010. And then starting in 2018, they turned that into a cryptocurrency that is being used by over 40,000 people now in predominantly rural parts of Kenya. And the phenomenon is getting to see this data from the blockchain, and you can calculate the velocity of the multiplier effect, right? How fast the money recirculates. So with an airdrop of say, 1.5 million USD worth of this local currency, you can see that it's been retransacted up to 11 times just within the last 9 months. So this is an incredible amount of economic activity that is being activated by having this cryptocurrency in the system. And so the idea here is, what if we could create so something like a USDC, but it would be within a jurisdiction. So in the US, we actually have a local currency program that's been in circulation since 2006 up in the Berkshires region. So Nick, I suggest you should go there and visit. It's in your woods. They've created this currency called Berkshires that is used amongst all these local small businesses. And they estimate there's a 4 times circulation of that money, which is much higher than the US dollar, which only has about a 1x circuit. So basically there's no multiplier effects. So if we can get banks to issue these community currencies for their local economy, you get actually 2 multiplier effects. So I think Brian Brooks in the previous session talked about the Community Reinvestment Act. So this is my pitch to Brian. If you can get community development financial institutions, which are banks, some of them are banks, to be the issuer of community currencies, the reserves, the fiat reserves would go into these banks as deposits, and they can then lend out 90% of that into the community. And being community development banks, they're required to relend into these underserved communities. So you're getting a multiplier effect there from the reserves based on fractional reserve banking. And then you're getting this additional multiplier effect with the stablecoin itself, the community currency itself, recirculating at a higher rate within this network of local small businesses. So I think I think this is sort of the next phenomenon that I get really excited about, that here's a possibility of what this technology can do outside of just crypto trading.
Yeah, it's a really interesting use case. I think, like, just this idea of using it almost as like a local voucher program, or I'm even thinking of, when I buy like a coupon book to support the local football team or something, and I can redeem those coupons at different local stores and things of that nature. But I can't do anything with it outside of my community, but I can use it within the local area. So there's another interesting kind of commerce-based use case that I wanted to throw out there and see if folks had thoughts on this. But so Coindesk reported last year that like local Chinese importers in Russia were actually using Tether, the largest stablecoin, as a remittance service to send like something like $30 million a day back to China. So these Chinese importers in Moscow, they would drop off bags of cash of Russian rubles at OTC desks in Moscow. They exchange rubles for Tether, send that Tether back to China, and then they would, exit into one and be a local market maker. And this was something like $30 million a day that we reported this was happening. And it kind of highlights this idea of like censorship resistance as a use case here. And Nick, I know you mentioned earlier that like a lot of the people that are using these coins are, they don't necessarily want other people to know what they're doing or who they are. And without, making any judgments about what these people's intentions are, I mean, it could be perfectly fine. But like, what's your overall thinking around this idea of like censorship resistance as a use case? I mean, is this like a net positive, or is this something that people should be concerned about?
I mean, honestly, that's largely the purpose of crypto financial infrastructure, is to make financial decisions that some powerful third party doesn't want you to make. If you look at Tether, you look at when the transactions occur, most of them are happening on Asian trading hours. So it's not necessarily a Western phenomenon. And what's the reason for that? Well, China has capital controls, and a lot of people have an interest in evading those capital controls. That's kind of a plain fact, and not saying it with any aspersions, but fundamentally, crypto, public blockchains, the entire premise is giving people more discretion over their wealth. And now stablecoins complicate that slightly because you have a lot of them have these centralized issuers that can freeze accounts, freeze balances at their sole discretion. In fact, Tether has frozen, I believe, 100 accounts, and USDC has started to freeze accounts. They have different standards for what's worthy of freezing. Tether actually has more of a hair trigger finger in terms of what's worthy of freezing, whereas USDC has said they'll only freeze balances with a really concrete request from law enforcement. So there's kind of distinctions there, but fundamentally, one of the key premises of stablecoins is flattening out the kind of global financial infrastructure and routing around the kind of established correspondent banking system and creating a new alternative. And that's what we see them being used for.
All right. Well, I guess that's a nice segue into our regulation topic here, right? So Nigel, tell us a bit about, I mean, the third quarter, we saw a whole sort of groundswell of activity on the regulation, stablecoin regulation front in the US, EU, other jurisdictions, multilateral bodies. Maybe give us kind of an overview of what some of the key developments were over the last couple months from your vantage point.
Okay, thanks very much, Aaron. Yeah, I mean, a lot has sort of happened over the last few months. I mean, I think the real catalyst for this was the G20 at the global level was the G20 summit or the G20 meeting held last week, where the FSB produced a report on the regulatory issues on so-called global stable coins, and that sets out really 10 high-level recommendations for the regulatory community on how to approach the regulation of global stable coins. Those principles are necessarily at a relatively high level because of some of the issues that have already been discussed and challenged. There are many different types of stable coins. So actually, the regulatory issues are rather different and depend very much on the particular case. But the high-level principles and recommendations are designed to frame the overall approach by regulators. What we're now seeing in some national jurisdictions, you mentioned the US and EU, is we're now beginning to see national frameworks adapting or issuing their own sort of regulatory rules on guidelines on different aspects of stable coins. But as well as the work by the regulatory group, we also have seen reports coming out by the Financial Action Task Force, and also the IMF itself has done some work, and indeed is published today, on basically the kind of cross-border payments and digitalization, which includes stable coins, but a lot of it is about cross-border digital use of digital currencies. And we've also seen agreements at the G20 level on a roadmap for improving cross-border payments. So I think all these things are kind of coming together in a sense of tackling some of the issues in respect of can we improve the payment infrastructure, particularly the cross-border payment infrastructure. And the regulatory group on stablecoins is really setting out a frame and set of parameters to try and ensure that one can maintain financial stability, that one can maintain trust and confidence, that one can address financial integrity, and that one can meet money laundering kind of rules and regulations. And some of those, of course, are quite challenging, given the comments that Nick just mentioned. But I think if stable coins are going to have extensive use, these are issues that have to be addressed and have to be tackled. So I can pick up any more, but that's just a high-level introduction, Aaron.
Yeah, that's, and that's really helpful, because oftentimes when we're in the US, we also get very myopic and only think about our own jurisdiction. So it's good for you to help broaden our perspective so we can learn from other, global partners. Having said that, maybe kind of understanding kind of the European landscape, as you mentioned, Nigel, kind of looking a little bit closer to home, as Aaron mentioned, the last quarter was amazing for stablecoins in terms of their growth and proliferation, but it was also quite an eventful quarter in terms of the regulators really leaning in and starting to weigh in. And I think we can all acknowledge, and we have, that the future scale and sustainability of stablecoins is intertwined to the actions of the regulators. So in the US, when you take a look at what the OCC and the SEC have opined on, what does that tell you in terms of the future trajectory and sustainability? And Nick, maybe if I can start with you to weigh in, and then Nigel, would love to kind of get your follow-up perspective as, in looking at it from a European vantage point.
Well, I think the big open question is what will happen to Tether. Honestly, that's the elephant in the room. That's $16 billion held in offshore banks. Unclear which banks they are, and we know the NYAG has been trying to sort of reckon with them for a while and trying to apply pressure to them, but it's not clear what's going to happen there. If that does happen, if something adverse happens to Tether, that's a systemic event for the entire crypto industry, because so much of the exchange environment is denominated and settled in Tethers. The other big outstanding question for me is, what are the legal assurances of a transaction that you would make with a US domiciled fiat convertible stablecoin like USDC? If you look at their terms of service, it's actually, they admit that there's still open legal questions as to what the quality of settlement is and the enforceability of those transactions. And then there's this notion of whether the privacy model of stablecoins can persist. Issuers don't really have knowledge of every transaction that happens on a P2P network. They have knowledge of their counterparties who are creating and redeeming stablecoins. They don't have knowledge of every peer-to-peer transaction, even if it is with their coin. Can that much more open model persist? That's kind of the really big outstanding question for me.
And I think privacy is definitely one that's gaining a lot of dominance, including comments today from Chairman Jerome Powell. Now, he was talking about CBDCs and US not so much doing it first, but doing it right. And privacy was something he spoke about at length. Nigel, maybe a more pointed question, because we're up to time and I want to give Aaron time to close, is do you see future regulation driven by collaboration with industry or more so driven by enforcement?
I think regulation, what will happen in terms of regulation is there will be continued work by the regulators to try and provide reassurance that they are on the top of what the particular risks are. So the risks here that we've discussed are is the relationship governable? Is there appropriate data information? Is there appropriate clarity? Some of the issues that we've been talking around today are hitting some challenges if you look against the high level principles which have been set out by the FSB. I think the high level principles by the FSB will be the guiding force, and I think there will be quite a bit of regulatory activity by national regulators trying to translate those regulatory principles into actual frameworks. And I think that is what's going to happen at the high level regulation. Then at the level of individual actions, that will be for the national regulators with individual cases. And I'm not going to talk about that.
Fair enough. Fair enough. Over to you.
Can just really quick, I'm going to turn over to Alex here, and then we'll wrap it up here. But Alex, so a couple of months ago, you wrote an op-ed in Coindesk arguing that the only way for stablecoins to really achieve mass adoption is for them to effectively sever their connection to the banks or decouple from banks essentially as collateral holders, and then find a compliant way of keeping collateral outside of the banking system. Maybe in 60 seconds or so, can you kind of summarize your argument there as far as why you think that's necessary and why it's challenging?
This environment changes fast, but I keep my views, at least, for a period of 2 or 3 months. So my opinion right now is the same as it was in this paper. I really think that we underappreciate the instability of the banking system itself. The idea that you have an analog or equivalent of fiat currency backed by banking reserves, to my mind, doesn't make much sense, because even the best of the banks are still having, maybe 1% probability of default per year, which is not small at all, right? So from that perspective, I think that either creation of specially oriented narrow banks, something which I entertained for a little while, about leaving Bank of America, but was never given a get-go by the Fed and stuff like that. But simpler versions, including potentially broker dealers and other organizations which can actually hold collateral backed by short-dated government paper and held to maturity, and other vehicles of that nature seem to be a much better solution to the problem. Not to mention the other thing which is constantly forgotten in all these discussions, and the only reason why it is forgotten is because the sliver of stable coins, however fast it grows, is still minuscule in the big picture of things. So the other thing is that if one were to keep the collateral with the banking system, then there would be two sources of payment tokens in the system simultaneously, which will increase the inflation rate, overall, which is an Achilles heel of schemas like Libra, for example, and in fact unsurmountable in their way of thinking about it. So in summary, in the remaining 6 seconds, I can say, yes, we need to do our utmost to find ways of keeping collateral outside of the existing banking system in a legally regulatory compliant fashion.
They will be securities. Sorry, just wanted to say that in that model they would be securities.
Well, rather nuanced, and maybe we can discuss it offline, given that we have negative 2 minutes to continue.
All right, guys. Well, thanks, Fenny, Nick, Nigel, Alex, Sunena, and special thanks to Chris for hosting us today. And we'll turn it back to you guys, Chris.
Thank you very much.
Hello, my name is Lee Reiners, and I'm the Executive Director of the Global Financial Markets Center at Duke Law. At Duke, I teach a class titled Fintech Law and Policy, and I begin the course module on cryptocurrency by asking my students to define money. Those who have taken an undergraduate economics course typically offer the standard economist definition that money is a unit of account, store of value, and medium of exchange. This is a definition according to the functions money performs, but it fails to explain what money is. In my paper, Cryptocurrency and the State, an Unholy Alliance, I explain the essence of money and contextualize the rise of cryptocurrency within the historical relationship between money and the state. The anthropological record is clear. Money is fundamentally a social technology that allows for the measurement of debt. This is known as the credit theory of money, and I provide a concrete example in my paper. But if currency is simply anything that is used to clear credit accounts, how do you trust that a specific currency will be accepted? Enter the state, who has always had a vested interest in standardizing units of measurement within their borders. Because all citizens must pay taxes and thus share a common creditor, government-issued tokens can freely circulate as currency within the community. People are willing to accept these tokens as payment because they know they can use them to pay their obligations to the state. Thus, the state's role in money's creation is essential. Now, history does offer examples of privately issued token-based money, but such money only works in close-knit societies where transacting parties know each other's creditworthiness. Cryptocurrency attempts to solve the geographic limitations of previous forms of token-based money by representing a new form of community that is made possible by the internet. However, cryptocurrency does not fit neatly within the credit theory of money because there is no underlying debtor. When you spend a Bitcoin, whose obligation does this represent? Bitcoins are not issued. They are created using computer code, and they exist as computer code. If there is no issuer, then who or what are Bitcoin users trusting? Satoshi understood the central role of trust in sustaining private currencies, which is why the words trust or trusted appear 13 times in the Bitcoin white paper. Rather than trust a third party, Bitcoin's revelation was its underlying blockchain technology that allows network participants to trust the information recorded on a shared ledger without trusting anyone to validate it. Despite this new form of trust, Bitcoin and other cryptocurrencies have yet to meaningfully challenge fiat currency in fulfilling the three functions of money. This is partially due to design reasons, and partially due to the continued hold of the nation state as principal architect of social trust. As the origin of money demonstrates, the surest way to accelerate greater use of any currency is to grant it legal tender status. But why would a state relinquish the benefits of its monopoly over legal tender? For this reason, no country recognizes Bitcoin or any other cryptocurrency as legal tender, although several countries have passed laws that facilitate greater use of cryptocurrency. In my paper, I describe how US agency interpretations are largely premised on the historical reality that currency is the domain of the sovereign, and that this definition could possibly undermine cryptocurrency regulations should any sovereign adopt cryptocurrency as legal tender. This wasn't much of a concern until Facebook announced plans for Libra in the summer of 2019. Due to Facebook's scale, Libra was the first real threat to sovereign currencies. When the head of Libra testified on Capitol Hill shortly after the project's launch, he noted that the primary benefit for Facebook was the ability to drive more commerce on the platform. And if there's more commerce, there's more advertising revenue. Just as the state utilized its status as common creditor to create and circulate sovereign money, Facebook would tap its unique role as a global online community and marketplace to introduce a native, borderless currency. Facebook may not be a common creditor, but it is a common platform. Libra exposed the fragmented nature of cryptocurrency regulation in the US. As policymakers sift through and debate proposals to clarify and streamline cryptocurrency regulation, it's important they keep in mind the relationship between sovereignty and money. Unfortunately, recent guidance from the Office of the Comptroller of the Currency that allows national banks to custody crypto assets and hold stablecoin reserves threatens to undermine the dollar's status by accommodating the use of cryptocurrency in the banking sector. The acting comptroller's support for stablecoins is premised on an understandable desire